$1.4 billion for a robotics company from Stuttgart. 6 out of the 8 largest funding rounds going to defense, space, fusion, quantum or energy. And a neobank that took 8 years and 3 billion euros to make a profit of 1.6 million. And that might be the most important number of the first half of 2026. The consensus calls this a recovery. It is not. This was a structural rotation. And if you're still planning for the old market to come back, you're planning for a market that may no longer exist. Welcome to Startuprad.io. I'm Jörn, Joe Menninger, broadcasting from Frankfurt am Main, and this is our 2026 review of the first half, the most comprehensive English language analysis of what happened in Germany, Austria, and Switzerland startups ecosystems in the first 6 months of this year. If you're a founder, investor, corporate strategist, or policymaker trying to understand where European technology is actually heading, this is your episode. One note before we begin, since the period covered in this review, the KNDS IPO, the planned dual listing of the German-French defense group, has been postponed. We'll come back to what that tells us later. Let me give you 3 numbers. 1.4 billion US dollars. That is NEURA Robotics Series C, announced in June, the largest venture round in German history. Backed by Tether, Nvidia, Amazon and Bosch, a robotics company from Stuttgart, not a SaaS company from Berlin. 6 out of 8. 6 of the 8 largest funding rounds in Germany, Austria and Switzerland in the first half of 2026 went to defense, space, fusion, quantum robotics or energy infrastructure. The other 2 went to companies that had proven their unit economics under pressure. Software-only rounds are absent from the top tier. 1.6 million euros. N26 net profit for 2025. The first full-year profit in the neobank's 8-year history. After more than 3 billion euros in lifetime funding. Not glamorous, not viral, but possibly the most important number of the first half year, because it represents proof. Those numbers tell a story, and the story is not what the consensus thinks it is. In our Q1 review back in March, I called this market a selection event. I said capital was concentrating, not disappearing, and that the filter was perceived necessity. Does the world need this company to exist? We're now 3 months later. I think that call was directionally right, but it understated what was actually happening. This was not a selection event. This was a structural rotation, and the argument I'm going to make today is that the market that left in 2022 is not the market that came back in 2026. Scope and methodology for you guys. Before we go any further, a note on our method. This review covers January 1st through June 30th, 2026, with a few glimpses into July. It builds on our Q1 review from March this year. If you have not listened to that episode, I would recommend it because the argument here extends directly from the conclusions we drew 3 months ago. The geographic focus is Germany, Austria and Switzerland, with European transactions included where they materially affect a company's investors or policy in those markets. All rankings and percentages use a hard June 30th cutoff. Major July announcements, including Helsing and Proxima Fusion, are discussed separately as a post-period confirmation. Announced transactions are labeled as announced. Completed transactions are labeled as, you can guess it, completed. Where the companies report different kinds of profitability, net income, EBITDA, operating, those distinctions are also preserved. This is not your usual deal roundup. It's a structural argument supported by evidence. Our Q1 prediction tracker. Before we go into structural details, accountability. In Q1, I made 3 calls. Let me tell you how they held up. First, I said capital was concentrating into fewer, bigger bets, filtered by perceived necessity. I would say this is confirmed. 6 out of the 8 largest rounds in H1 went to strategic necessity sectors. This filter is real. Second, I said Germany's startup geography was splitting by function. Munich and southern Germany for hardware, defense and deeptech, Berlin for software and international talent. That pattern continued. The largest H1 round, NEURA Robotics in Stuttgart, Stark, ESA in Munich, Focus Energy near Darmstadt, were overwhelmingly non-Berlin. I covered the geography dynamics in depth in our Q1, so I will not repeat it today, but the direction has not changed. Third, I said the exit window was reopening only for companies that have already won. Partially confirmed, Talon 1 sold to Aiden for 750 million euros. OHB relisted in Frankfurt, raising 789 million. But the KNDS IPO was postponed, but according to the coverage, mostly due to political reasons. The window is open, but it remains selective. One more thing. In Q1, I mentioned NEURA Robotics at roughly 1 billion euros. They closed at $1.4 billion, larger than expected. And ESA Aerospace closed at 270 million euros, broadly in line. The Q1 signal base held up. Now let me show you what happened next. Our thesis, the structural rotation. The headline recovery European venture capital concealed a structural rotation underneath. Capital did not return evenly to the categories that led the previous cycles. It concentrated around companies that governments, industries, enterprises, militaries, and supply chains increasingly need to exist. At the same time, the surviving companies from the 2019 to 2021 cohort were rewarded, but only after proving the economic structure under pressure. In Q1, I talked about perceived necessity as the filter. Today, I want to formulate that into a framework, what I'm calling the strategic necessity test. The strategic necessity test asks a simple question. Is a company being funded because it could become very large, venture optionality, or because governments, enterprises, industries, defense systems, or supply chains increasingly regarded its existence as strategically necessary? In Q1, I described it as, if your company disappeared tomorrow, would it matter? That was the instinct. What H1 gave us is the evidence to make this structural. 6 of 8 top rounds, defense procurement at institutional scale, SAP building a €1 billion AI stack. This is not a sector preference. This is a change in the source of demand from discretionary adoption to strategic requirement. Let me make a little contrast between NEURA Robotics and DeepL. What happened? The first contrast. In May, DeepL, one of Europe's most recognized AI companies, reduced its workforce by 25%. In June, NEURA Robotics, a Stuttgart-based robotics company that most people outside of the industry had never heard of, raised $1.4 billion, the largest venture round in German history. Why structurally? Why is physical AI attracting extraordinary capital while leading European language AI company is under pressure? The answer is structural. Independent European language AI companies face increasing pressure from US hyperscalers that can subsidize inference costs, bundle distribution, and absorb losses. Physical AI, robotics, industrial automation, embodied systems aligns more closely with Europe's existing industrial strength, manufacturing, engineering, precision hardware, automotive supply chains. What changes next? This does not mean language AI is finished. It means the defensibility of standalone European language AI companies is weaker than many assumed in the past, and it means that strategic necessity test favors companies with physical, industrial, or sovereign modes. What people are getting wrong? The misread is assuming that all European AI is in trouble. It is not. The companies under pressure are those competing head-on with US hyperscalers on model capability. The companies attracting capital are those building things that hyperscalers cannot easily replicate: physical systems, industrial deployment, hardware integration. If I were a European AI founder, I would stop competing on model capability and start competing on deployment complexity. The harder it is to install, the safer is your moat. Contrast 2. Aleph Alpha versus SAP. What happened? This is our second contrast. In April, Cohort, a Canadian AI company, announced the acquisition of Aleph Alpha, Germany's sovereign AI poster child. The Schwarz Group, parent of Lidl and Kaufland, invested 500 million euros into the combination. In the same period, SAP, Germany's largest technology company, acquired Prior Labs, invested 60 million euros in N8N at $5.2 billion valuation, and committed more than 1 billion euros to AI. Why structurally? Is European AI sovereignty more likely to emerge from an independent foundation model champion or from a corporate enterprise stack? The Aleph Alpha outcome suggests that independent European foundation model companies face structural pressure that no amount of government enthusiasm can fully offset. The SAP strategy suggests the answer may lie not in the model sovereignty, but in the application sovereignty, owning the enterprise workflow, the industrial integration, the specialized deployment. What changes next? Europe may not win by duplicating the American foundation model stack. Its stronger position lie in industrial deployment, enterprise workflow, specialized models, and physical system. Watch SAP's next acquisition. The stack is still incomplete. What people are getting wrong? The misread is framing the Aleph Alpha story as a failure of ambition. It was not. It was a structural outcome. Building a standalone European foundation model to compete with OpenAI and Anthropic requires a capital base that does not exist in European venture capital. The Aleph Alpha team did not fail. The market structure made the outcome close to inevitable. The real question is whether SAP's counter strategy, building the European enterprise AI stack through acquisition, works. If it does not, it is a more defensible version of AI sovereignty than a standalone model company would have been. After a short break, we'll be back with why 4 companies that everyone wrote off 2 years ago might be the most important data points in the European venture capital right now, and why the strategic necessity test should change how you evaluate every capital raise you see for the rest of this year. N26 and the profitability cohort versus KNDS. What happened? The third contrast, N26, 8 years, 3 billion euros in lifetime funding, posted its first full year net profit, 1.6 million euros. Personio reached profitability. Flink reported EBITDA positive results. Finn reached unicorn status on 300 million euros in annual recurring revenue. Meanwhile, the KNDS IPO, perhaps the most politically significant capital markets transaction in German defense, was postponed because investors resisted devaluation. Why structurally? Why do a newly profitable scale-up and a postponed sovereign hardware IPO reveal about the new market? 2 things. First, proof of economics is being rewarded. The market is no longer paying for narrative at the top end. It is paying for evidence. N26 Personio Flink. These companies were not rewarded for surviving. They were forced to prove that their business model could function after capital became scarce. I'm calling this group the Profitability Cohort. Companies substantially funded during the 2019 to 2021 boom that survived the 2022 to 2024 capital reset and reached meaningful profitability by H1 2026. And what I want to be precise here, N26 reports net income. Flink reports EBITDA. Personio's public reporting does not specify the metrics. Fin reports revenue at scale without a profitability claim. These are different things. I'm not collapsing them. Second, strategic importance does not eliminate pricing discipline. The KNDS sovereign mandate, German and French government stakes, Bundeswehr expansion, NATO requirements has not changed, but investors still impose valuation limits. Strategic demand can attract capital, but it cannot suspend financial gravity. What people are getting wrong, the temptation is to treat profitability as a sign of maturity. It is actually a sign of survival. These companies did not mature into profitability. Capital scarcity forced operation discipline, and the survivors emerged with evidence that the economics could work. The lesson for the next generation is not build for profit, it is plan for capital to disappear. And the tracking question going forward is, does the Profitability Cohort now produce IPOs and substantial exits? That is where we'll see whether the survival was a bridge to scale or just a bridge to another funding round. Our implications of four-way split. For founders, if you're a founder, the strategic necessity test is your position filter now. This could be large, is no longer sufficient at the top end of the market. The strongest race increasingly answers a harder question. What breaks if the company does not exist? Distinguish real structural demand from fashionable language. Build for periods with external capital disappears. Understand who your likely corporate acquirers and strategic partners are. SAP, Siemens, Bosch, defense procurement agencies. And treat Germany as a specific market with its own institutions, buying cultures and timelines, not a generic European launchpad. For investors, if you're an investor, the relevant shift is not merely sector preference, it is a change in the perceived source of demand, from discretionary adoption to strategic requirement. Separate, durable demand from inflated pricing. The KNDS postponement shows that strategic sectors can attract institutional capital and still be overpriced. Evaluate whether your sector exposure reflects a genuine mandate or crowded momentum. Review the 2019 to 2021 portfolio against profitability and capital efficiency benchmarks. And watch whether institutional capital, pension funds, insurance, sovereign wealth participates in later stage strategic rounds or whether the follow-on capital remains American. For corporations, if you're a corporation and think this audience matters more than most startup coverage acknowledge, the structural rotation has direct implications. The SAP playbook shows that corporate acquirers are not waiting for startups to mature. They are actively building stacks, acquiring capabilities, and investing strategically. Identify which startup categories have become strategically relevant to your industry. Use partnerships, investments, acquisition, and strategic content to build credible positions before your competitors do. Treat European AI and industrial technology as ecosystem building questions, not software procurement decisions. For policymakers and economic institutions. For policymakers, procurement access matters more than startup grants. Institutional capital mobilization, getting pension funds and insurance capital into later stage rounds matters more than accelerator programs. Monitor talent concentration. The defense sector is pulling engineers from commercial technology, and that is a real ecosystem effect that is not being measured. The digital omnibus is a legislative win, but implementation is everything. Measure results, not announcements. And recognize that defense and strategic technology are changing university and labor market incentives in a way that will take years to become visible. 5 predictions for the second half of this year. 5 things I'll be tracking in the second half of 2026 and will hold myself accountable for these in the next review. 1. KNDS will formally restart its IPO process by end of March 2027. Confidence 7 out of 10. The sovereign mandate has not changed. The pricing needs adjustment. 2. At least 2 German defense, robotics, space, quantum or strategic infrastructure companies will announce priced equity rounds above 1 billion euros by the end of 2026. Confidence 8 out of 10. 3. SAP will announce at least 1 further material AI acquisition by the year's end. Confidence 6 out of 10. 4. DeepL will announce a material strategic transaction financing or restructuring by the end of June 2027, reflecting increased competitive pressure on its standalone position. Confidence 6 out of 10. 5. At least 1 member of the Profitability Cohort N26 Personia Flink or Fin will announce an IPO mandate, regulatory filing or formal strategic sale process by year-end 2026. Media speculation does not count. Confidence 5 out of 10. Post-period confirmation. July reinforces the thesis. 1 more piece of evidence from after the reporting period. In the first 2 weeks of July, 2 further announcements confirmed that the H1 pattern was not slowing down. Helsing raised $1.8 billion at an $18 billion valuation, the largest European defense round in history. It also makes Helsing Germany's most valuable startup, and Proxima Fusion raised 411 million euros for nuclear fusion with RWE and Google as strategic investors. I'm not counting these in the H1 numbers, but they reinforce the direction. Strategic necessity capital is accelerating, not stabilizing. For the end, we have an announcement. Before I close, there's one more announcement. This review has shown that capital is no longer moving through the German startup economy in the same way it did during previous cycles. But that raises a larger question. What does Germany's billion-dollar startup landscape actually look like? Which companies remain genuine unicorns? Which have gone public, been acquired, falling below the threshold or disappeared? Which cities and sectors are producing the next generation? And where are capital, talent, founders and strategic demand concentrating? Starting next week, Startuprad.io will begin publishing the German Unicorn Atlas. This will be our data-led map of Germany's billion-dollar startup economy. Active unicorns, former unicorns, public companies, major exits, regional clusters, founders, investors, and a structural pattern connecting them. It builds on our existing unicorn coverage, but it goes considerably further. The Atlas will not only tell you which companies cross the valuation threshold, it will show what Germany's unicorn population tells us about capital, geography, industrial strength, and the changing logic of European technology. The first part begins next week, because the unicorn list is a snapshot. An atlas could explain the territory. Where Startuprad.io is heading, the Unicorn Atlas is also part of a broader expansion of our work at Startuprad.io. We increasingly hear the same commercial question from founders, investors, corporations, and international companies. How do you enter Germany? How do you build credibility here? who actually influences the market, where are the relevant customers, partners, investors, founders, and technology clusters, and why do strategies that worked in the United States or even elsewhere in Europe often fail when transferred directly to Germany? We will address more of those questions in the upcoming analysis. Europe is not a single market. Growth across Europe means understanding different economies, institutions, industries, buying cultures, and startup ecosystems. We'll begin with Germany, Europe's largest economy and one of its most important but frequently misunderstood technology markets. The objective is practical. We do not only want to report what is happening in the ecosystem, we want to explain what it means for companies trying to enter, grow within, or build authority and develop meaningful commercial relationships here. This was Startuprad.io review for the first half of 2026. Here's one thing I want you to take away. The market that left in 2022 is not the market that returned in 2026. What returned is harder, more selective, and increasingly organized around one question. Does the world need this company to exist? The founders, investors, corporations, and policy makers building around that questions will define the next decade of European technology. Beginning next week, the German unicorn Atlas will show us where those companies are being built, which ones survived, and what their development tells us about the market. And in the month ahead, we'll go further into the commercial question behind the headlines: how companies enter Germany, build credibility, find the right partners, and grow across Europe's distinct markets. If this analysis was useful, share it with one person still operating on the assumption of the previous cycle. I'm Menninger. We'll see you in 2 weeks.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io. Remember, sharing is caring.